24 wins, 2 not wins, 1 tie, something like that.
Steve Jobs was all about the customer doesn't know what he or she wants. I know what the customer wants.
Clearly a win. I think you just monetized $800 million. That's what I read in the papers.
We sold about $1 billion. If I were a stock, it would look something like this after business school, you know.
What exactly does Pershing Square Capital do? What's the general investment style, and why did you set it up that way?
So the vast majority of capital invested in the markets today is passive. So if you think of index funds or ETFs or even the big kind of long-only institutions, the vast majority of that capital is by charter passive. Passive means you do your research, or in some cases you don't do the research. You sort of just blindly follow an index and you're judged based on how closely you follow the index. If you think about investing 100 years ago, though, you had Andrew Carnegie owning 20% of U.S. Steel, or you had J.P. Morgan as a large owner of various companies over time. And in the old days of investing, an owner would act like an owner. So if they were unhappy with the performance of the business, they would replace the CEO. If they were unhappy with the board's judgment, they would make changes to the board. And as capitalism sort of democratized the investment process, and as any kid in business school can open a brokerage account, and as the owners of many of these great businesses over time, gave the shares away to a university or their heirs, and the ownership was spread out. The Sam Waltons of the world kind of passed away, and the boards became to be managed by professional owners. And so, what we do is we look for situations where a business has lost its way, where an otherwise great company in a business that we would define as one that has significant barriers to entry, that Warren Buffett would describe as having a moat around it, a business that is simple, predictable, generates cash, and we can be confident will be here 50 years from now. A good example is we own a stake in Canadian Pacific, which is a railroad in Canada. And if you think about the railroad business, it's a business where they're not going to build a new one across the street. You can have, absent some fairly dramatic changes in technology, you can be pretty comfortable that goods will be shipped on rail for a very long time to come. So it's a business we can predict. We can think about it from a very long-term perspective. We can buy it at a price that's interesting. And in the case of CP, this was the worst-run railroad in North America. It had the lowest profit margins. It was trading at the lowest valuation relative to earnings, and had a very unhappy shareholder base, but there was nothing they could do about it because they were inherently, again, the biggest investors tend to be very passive. And we saw an opportunity, and the opportunity was if you could replace the worst CEO in the railroad industry with the best CEO in the railroad industry, a lot of money could be made. And we bought first 12% of the stock and then another 2%, so about 14% of the stock. We recruited a guy named Hunter Harrison, who is widely considered the best railroad executive of all time, certainly in North America. He had retired at 65. He was 66 and a half. He had signed a 2-year non-compete with his employer, and I think the biggest mistake they made was a 2-year non-compete because he was running the other Canadian railroad, Canadian National. And we hired him as a consultant. He helped us study the railroad, and he had plenty of fire in his belly. And we said, look, would you be interested in a day job? And he said, let me check with my wife. And she said, you know what, it's time to get you out of the house again. And
my wife says that all the time.
and we recruited him, and then we had to simply put him in place. Now, the problem was Canadian Pacific has one of the most sort of esteemed and illustrious boards in Canada, at least at the time. And it was the former head of the Royal Bank of Canada, the former CEO of Suncor Energy, the former head of the steel business. It was a very, very important board. And they didn't like the idea that this idea was coming from outside the company, so they said no. So we went to the shareholders and we ran an election, a proxy contest. We put up 7 directors for 7 seats on a 13-seat board. And the shareholders voted with us 90% of the time and voted against the other guys. And they got between 3 and 11% of the vote. We put our directors on. We did a review of the best CEOs in the world. Turns out the guy we identified was the best guy. We put him in as CEO, and that was 16 months ago. And it's almost the most profitable railroad in North America after 16 months. That's how quick this guy goes to work. The stock's gone from $46 to $151 a share. It's, a little under $8 billion market cap to a $25 billion market cap. And that's kind of the perfect example. Now, it doesn't always work that way.
I think what you've said in some of your recent things, where you've had some things that you've learned from those experiences. They might include, for example, JCPenney that's been in the news this summer. So what have you learned from the successes, and then maybe what have you learned from the ones that haven't been successes?
JCPenney, for those of you who are not familiar, is a 112-year-old American sort of iconic retailer that's certainly way past its prime. It probably peaked 25 or 30 years ago. Again, another example, you had James Cash Penney, who founded the company. He died, I think, in the early 70s. And there's a pretty good correlation between when the founder goes and when the company goes. And part of that has to do with governance, which is a topic I'm sure we'll get to. But the time we invested, JCPenney stock was down from $80 to about $20 a share. It was trading at about 4 times operating income. It had lots of assets lying around in the company that were non-core assets. It had a very bloated expense base. And it was generating very little sales per square foot. It was a very underachieving retailer. And part of that is the brand had become somewhat tired, and they had gone to a very highly discount-oriented model where they'd mark a dress at $40, and they wouldn't sell any at that price. And a week later, they'd mark it to $20, and they probably wouldn't sell many at that price. And then they would send you a coupon where you got $10 off, and then they start to sell a few. And then if you used your credit card, you got $4 off, and if you bought this moment, you get another $5 off. And eventually, it was, $8 or whatever, and they sell a lot of them at that price. And but this was undifferentiated merchandise. And the thesis was this company has actually still a brand, well, faded, restorable. And because they were created over the last 112 years, they actually own about 112 million square feet of some of the best real estate in the shopping mall, in the shopping real estate industry. They own or have very long-term leaseholds at very low rents. And we said, look, this is a great platform to rebuild the company. And we bought a 16% stake in the company. I was invited to join the board. I joined the board with a friend who bought 10% along with us, so we owned together 26% of the company. We both joined the board. We were 2 of 11 directors. And the CEO was 64, and the board was very much focused on succession, as any board should be generally, but particularly when their CEO is in his mid-60s. And we helped the board with succession, and there was a candidate that kept surfacing as the best guy in retail. And this guy's name is Ron Johnson, and he had an ideal background. He didn't go to the Oxford Business School, or Said. He went to Harvard Business School. And he graduated. He went to work for Mervyn's. His dream in life was to reinvent the department store. And Mervyn's was kind of a dying department store. It was acquired by Target. So he spent a few years at Mervyn's. He spent 10 or 11 years at Target, which is probably the best-run U.S. discount department store. And then he was hired by Steve Jobs to build the Apple Store from a blank sheet of paper. And he did an absolutely incredible job. And we said, look, you couldn't ask for a better background to do what we're trying to do here. Reinvent the department store. Combine the Apple customer store experience with kind of some of the Target brand excellence and cost management. And the problem was recruiting him. He's very happy living in Atherton, California. He had $400 million of restricted stock in Apple, $100 million of which he was going to lose if he left. And he had kids who were in 13, 15 years old in the middle of their, at a time when parents don't like to move. But I managed to convince him to take the job. And he walked away from $100 million in restricted stock. We gave him $50 million to make up for it, but he still took a loss when he took the job. And then he invested $50 million in 7-year options that he bought with his own money that he couldn't sell for 6 years. So I thought this is the absolute perfect thing. We have the best guy. We've got a great platform at a really cheap price. We have the perfect alignment of incentives. And I thought, it's done.
But it didn't work.
But it didn't work. And so Ron got started in November of 2011. And he proceeded to make a series of changes, many of them very favorable. Among them, he took a very hard look at the cost structure and found about $1 billion that he could take out of the cost structure of the business. We took a hard look at all the non-core assets, and we monetized about $600 million of the non-core assets. So far, so good. And then he launched a business plan to convert the JCPenney store into basically a mini shopping mall, a Selfridges type model where there were a series of brands, each of which would have their own kind of presence in the store. And then you'd have a consolidated checkout with a wireless experience and sort of this Apple-like customer service experience. And he sold this idea to brands that heretofore wouldn't be willing to go into JCPenney. And the guy's very charismatic. It was a great idea. And he had a whole bunch of brands that he got from around the world who were excited about opening up inside JCPenney. And he went to work. But he made one very significant strategic mistake. This whole notion of what he almost called fraudulent pricing, this overpricing an item and then marking it down and coupons. He said, look, this is a waste of time. Let's just market at the price. The consumer knows the fair price. Because when you looked at those $40 dresses and $40 shirts, they all sold it for something like $12.30 on average, and very little sold at any other price. He said, let's just market at $12. The consumer understands value. We can save a huge amount of, the company had spent an enormous amount of man hours actually changing signs. If you think about how often they're constantly repricing and reticketing and changing signs, it made the stores look really cluttered. And, it sounded like a brilliant idea. And the Apple experience was not about testing. So instead of trying this out in 1 or 2 stores or in a region, he rolled it out across the country. And it failed. And the customer who had become accustomed to getting coupons in their Sunday circular, all of a sudden the coupons weren't there, and so they decided not to come. And we lost about a third of our customers after about 12 months. And the great thing about a retail business, if you get it right, is this business has enormous operating leverage, right? Because you've got a substantial fixed cost base, but once you start generating additional sales, it almost all drops to a lot of it drops to the bottom line. Well, only problem with leverage, as you learn in business schools, it works in reverse. And so all of a sudden the company was losing huge amounts of money after having spent a ton of money on capital, rebuilding, and redesigning these stores. And we found ourselves in a turnaround 15 months after he was hired. And we had to replace him.
And the lesson?
There are many. So number one, this was what I call an extreme makeover of a company. And when you do an extreme makeover, it requires perfect board alignment and backing for the CEO. And we didn't have that. Number one, we were one of 11 directors on the board, and there was still had it worked perfectly from the beginning, there wouldn't have been a problem. As things got dicier, there was a divergence of opinion on the board of what to do and when to do it and who to hire. So I think that's one interesting lesson. I don't think I'll ever go on a board and be one of 11 anymore. I like going on with a mandate like in Canadian Pacific. Two, I think Ron is an incredible talent, but I don't think, like the students in the room, he'd ever made a mistake before. And I think it was, as the data kept coming back, Ron still had a lot of confidence it was going to work. And you've got to back your CEO and give him rope. And I think Ron will be, and I think he'd say this today, he'll be a much better CEO the next time because having had a big negative experience like this. I think third, retail is one of the businesses where you can really test, right? You can take a region, you can take a store, and you can try things out and rejigger them and test them. And I think, the Apple experience, Steve Jobs was all about the customer doesn't know what he or she wants. I know what the customer wants. And Steve Jobs, got it right. I think in retail, there's a kind of a saying, the customer knows what he or she wants. And I think you really have to listen to that.